Curth, thanks very much for joining us. Just first of all, just tell me a little bit more about FAP, just for those viewers and listeners who don't know the company.
FAP, which I've incepted in 2005, grew as a more or less classic debt advisory firm, and we converted FAP in the last 4 years into a professional real estate debt investment platform, where on the one hand we have the debt advisory section, but on the other hand we have with FAP Invest, a debt investment platform where FAP is advising institutional type investors who are interested in investing in real estate debt, senior whole loans and mezzanine. And underneath that section, roughly 1.5 years ago, we have incepted our first mezzanine fund, precisely designed for German investors, but also open for people from abroad, mezzanine fund targeting the German real estate financing market. All in all, maybe finally, FAP has structured more than 14 billion euros in capital since inception of the firm.
Great, thank you. I wanted to just dig down a little bit into the finance markets, because that's the element of your expertise. But first of all, let's just look at the macro position at the moment. How do you see this particular crisis from a finance perspective? I guess in comparison to previous crises, and I'm thinking particularly about 2002, 2007 and 2008.
Yeah, I think the main point is it's not a financial crisis, or the origin of the crisis is not a capital crisis, maybe what we had in 2008 and 2009. There is enough capital in the market, especially in Germany, from different sources, still from banks and lower savings banks, but also from other non-banks, how we call them. So I think that's the main difference. The question is, will that capital be invested from our end in debt or not at the moment, or will people simply wait what we're seeing? But I think that's the main difference at the moment. But I must admit, we do not know whether kind of financial crunch or financial limitation will come up.
And just give me some insights, if you can, in terms of the German market at the moment. What are you seeing in terms of the availability of lending? Are the banks working? Is there differences between the different sides, whether that's bank lending, non-bank lending?
If you're reviewing the last 4 weeks, you can identify, let's say, 4 groups. I think that's the best way to say. First, the ones who have simply stopped their business, who are not doing any new business. Larger banks, the mortgage banks, but also especially smaller regional banks like savings banks, who are focusing on supporting their small and mid-cap companies with the subsidized loans, and where real estate finance is simply the second game which they are playing. That's the one group, maybe who are simply stop business in real estate finance. The second group is the ones who are maybe doing business, but on a very selected basis. Saying they're doing business for plain vanilla deals, maybe a residential portfolio in good locations, a low leverage deal, maybe 60% LTV, and maybe with increased margins or increased liquidity premiums. This is what we're seeing. And the third ones, and this is what we're seeing more from non-banks who are not using, let's say, the refinancing market through fan briefs, etc. Let's say an insurance company or a pension fund directly providing money, or a debt fund. Most of them are doing business as usual, what we've seen so far. I must say so far, because I mean, this is just 4 weeks ago when we saw significant moves. But business as usual means they're doing business. They have not increased their margins. Maybe they are also a bit more selected on leverage, but they're doing business. And the fourth group is, let's say, how we call them, the opportunity hunters, who already called us, maybe especially private equity funds who are active in debt, who are already looking for distressed debt situations, providing capital for either loan-to-own strategies or looking for business. I think that's the 4 groups from the principal banking sector or lending sector.
Thank you very much.
Thank you, Richard.